Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2024 October-November Paper 4-2 question number 1. This is the structured paper 4, which consists of 2 questions. Each of them will be of 25 marks and the total time limit for this paper is 1 hour. So ideally, you should be spending about 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve this question number 1 under 30 minutes. So without any further delay, let's get started. Tea Limited manufactures one product which has been on the market for many years. It operates a standard costing system. The budgeted sales for August were 2,000 units. We have been given the standard unit cost, the direct material, direct labor, as well as the fixed overheads. Then variance analysis has been carried out for August. The actual result and the relevant variances are as follows. So we have been given the variances as well. Let's take a look at the first question. We need to explain 2 reasons why a business may conduct variance analysis. So the very first reason is to compare the actual result to the budgeted values so that actions can be taken for remedy or for improvement. Let's write it down. To compare the actual results and the budget so that actions can be taken for remedy. This is because variance analysis will give us information regarding which part is favorable and which part is adverse, and it allows the managers to take remedial actions against the adverse variances. Now, the second reason to conduct variance analysis is to measure the performance of the managers in order to determine their bonus eligibility. Because if they are doing good and if all of the variances are favorable, it means that the managers are doing their work properly, which will allow them for a higher bonus. Let's write it down. To measure the performance of the managers to determine bonus eligibility. That is all for the first part. Let's move towards the second part. We now need to state how to calculate a fixed overhead capacity variance. So the formula for the fixed overhead capacity variance is just going to be the standard hours for budgeted production minus the actual hours, and we need to multiply it by the overhead rate per hour. And always remember that the overhead rate per hour will be the standard fixed overhead. Let's write it down. So it will be the standard hours for budgeted production minus the actual hours, and we need to multiply this by the standard fixed overhead rate per hour. This part is also known as the OAR, which is the overhead absorption rate, and this will be per hour based on the standard value. That is all for the second part. Now for the third part, we need to prepare the flexible budget statement for the month of August. In this case, we have the actual results, and the flexible budget is just going to be the standard value per unit multiplied by the actual number of units. And within the insert, we have been given the standard values per unit, and we know the actual number of units as well. So this should be quite simple. Let's start with the sales value. Okay. So for the sales value, we have the actual sales right here, but we do not have the standard selling price per unit, but we are given the sales price variance, which is 5,400 favorable. And the sales price variance being favorable means that the actual sales is 5,400 greater as compared to our budgeted sales. And in this case, we are producing a flexible budget. It means that we are corresponding to the actual number of units, which is 1,800. Now, in order to calculate our budgeted sales, what we can do is just subtract this favorable sales variance from our actual sales value so that we get the budgeted sales value but for the actual number of units. Let's calculate it. So that will be 239,400 minus 5,400. This results in the value of 234,000. Now we need to calculate the direct materials. We have been given the direct materials standard price per unit, which is 24. We can just multiply it to the actual number of units, which is 1800. So that will be 1800 times 24. This results in the direct materials to have the value of 43,200, which we need to subtract. Then we need to calculate the direct labor. Again, direct labor rate per unit, the standard rate, is given to be 60. We can just multiply it to 1800, which is the actual number of units. So 1800 times 60. This results in the value of 108,000. And the final thing will be our fixed overheads. Okay, for this as well, we have been given the standard fixed overhead per unit, which is 40. We just need to multiply it to the actual number of units, which is 1800. So that will be 1800 times 40, which results in the value of 72,000. Now we can get the flexible budget profit. So that will be 234,000 minus 43,200 minus 108,000 minus 72,000, which results in 10,800. That is all for the third part. Let's move towards the fourth one. We now need to prepare a statement reconciling the flexible budget profit in part C with the actual profit. In order to reconcile, we just need to adjust our variances. All of the favorable variances should be added and all of the adverse variances should be subtracted. So let us start with the flexible budgeted profit. So flexible budget profit, which is what we calculated just now, that was 10,800. Now the variances that we need to adjust in this case will be the sales price variance. Remember, we never adjust the sales volume variance. Then let's take a look at the list of the variances. We need to adjust the total direct material variances, total direct labor variances. Then we need to adjust the total fixed overhead variance. Let's first write down the name of the variances. So sales price variance, total direct material variance, total direct labor variance, and total fixed overhead variance. And always remember that the total variance is just going to be the actual result minus the flexible value, which we just calculated in part C. Okay, for the sales price variance, that is 5,400 favorable, so we need to add it. So 5,400. Then total direct material variance is 1,440 adverse, so we need to subtract it. Then the total direct labor variance is 1,980 favorable, so we need to add it. Then for the total fixed overhead variance, we need to compare the actual result to the flexible result or the flexible value. So the actual result is 84,000, whereas the flexible fixed overhead is 72,000. So in actual, we had to pay higher fixed overheads. So that is an adverse condition. And the adverse value is just the difference. So 84,000 minus 72,000, which results in 12,000. Since this is an adverse variance, we will have to subtract it. Now this should give us the actual profit. So that will be 10,800 plus 5,400 minus 1,440 plus 1,980 minus 12,000, which is 4,740 positive. And we can also check this value within our insert because we have been given the actual profit right here. So it's the same one, which means that our reconciliation statement is correct. That is all for the fourth part. Let's move towards the next one. the actual labor rate in August was 15.50, we need to explain the likely reasons for the favorable direct labor variance of 1980 with reference to the analysis of its two subvariances. So in this case, we just need to calculate the two subvariances. Let's start with direct labor rate variance. So the formula is just going to be the standard rate per hour minus the actual rate per hour multiplied by the actual hours. Okay, the standard rate was given above, and we're looking at the rate per hour. We can see that it's 15, and the actual rate per hour is given right here to be 15.5. Now we need the actual hours. In this case, we can see above the actual direct labor. This is just the actual hour multiplied by the actual rate. So 106,020. And we know that the actual rate per hour is 15.5. So we can easily calculate the total actual hours. That will be 106,020 divided by 15.5. This results in the value of 6,840. So 6,840. This results in the value of 3,420 adverse. Adverse because we paid a higher actual rate as compared to the budgeted rate. Now we need to write down one possible reason for the direct labor rate variance being adverse. In this case, we are paying a higher wage rate, which might be due to more skilled labor. The higher wage rate might be due to more skilled labor. Okay, now we need to figure out our second subvariance, which is the direct labor efficiency variance. The formula is just the standard hour per unit minus the actual hour per unit multiplied by the standard rate per hour multiplied by the actual units. Okay, so the standard hour per unit is given within our insert. Each unit requires 4 hours of direct labor. Now we have already calculated the total actual hours. In order to get the actual hour per unit, we can just divide this total actual hours by the actual number of unit, which is 1800. So 6,840 divided by 1800, that will be 3.8. So 3.8. Now we need to multiply it by the standard rate, which is right here, that's 15, and the actual unit is 1800. This results in the value of 5,400 favorable. Favorable because the workers had to work low hours as compared to what we actually budgeted. Now we need to provide one possible reason for this, the workers being more efficient. So one possible reason is maybe due to the use of higher quality materials. So the decreased hours may be due to the use of higher quality materials. Okay, that is all for this part. Let's move towards the next one. We have been given some additional information. The directors are aware of an upward trend in the direct material price. To keep the current profit level, they have two options. Option 1 is to modify the existing product so that it requires less direct material. Option 2 is to reduce the advertising cost by 1/3. We need to advise the directors which option they should choose by justifying our answer. This is a 7 mark. So whenever we are answering advice questions, we need to reserve 1 mark for the final decision, and we need to divide the remaining marks equally among our options. So option 1 will get 3 marks, option 2 will get 3 marks. It means that we need to write down 3 comments for option 1, 3 comments for option 2. Let's start with option 1. So modifying the existing product so that it requires less direct material. If we are using less direct material, then the modified product might be perceived to be of lower quality. Let's write it down. The modified product might be perceived to be of lower quality. And due to this reason, loyal customers might not like this product anymore and the demand might fall. So this might cause the demand to fall. But this will definitely save the direct material cost in order to increase the current profit level. So this will save direct material cost to increase the current profit level. That is all for option 1. Now for option 2, we will be reducing the advertising cost by 1/3. Now, advertising definitely helps to retain existing customers. That's the first thing we can write. Advertising helps retain existing customers. And if we are reducing advertising, it means that we are reducing our expenses, which could definitely increase our profit. So reducing advertising cost may increase profit. But if we are reducing advertising, then it may lead to loss of customers as well. So reducing advertising may lead to loss of customers because customers might move towards competitors. Now, based on these factors, we need to make a final decision. So in this case, I would suggest the directors to go with option 1 because the modified product might be suitable for a new customer base, or it might appeal to new customers. So the directors should choose option 1 as the modified product may be perceived as a new product and appeal to new customers. Alright, that is all for this entire question. If you found this video useful, make sure that you like the video and leave a comment below, and make sure that you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.